Are you ready to brace for impact? Well, up to 40% of Canadians are going to renew by the end of 2026, which is crazy. And hundreds of thousands of those people are going to see their mortgage payments go up dramatically, as much as 40% in some situations. But what if you could turn that risk into a strategy? I'm going to unpack in this specific video the risks associated with the upcoming renewal wave and the reality of the different things that you can do for your own specific mortgage to be able to put you in a better situation. By the end of this video or podcast, wherever you're listening or wherever you're watching, I'm going to have told you exactly what to expect and what to do. Let's get into it, shall we? Welcome to The Flow, Real Estate and Money Show, a show focused on helping Canadians understand the different elements of real estate, mortgage, and finance. The goal of our show is to provide Canadians with the tools, information, and knowledge to have more success when it comes to their investing and real estate related decisions going forward. My name is Alex McFadden, and I'm your host. I can't wait to get you into the flow. What's up, guys? My name is Alex McFadden, the owner and lead advisor here at Flow Mortgage Co., where we focus on teaching our clients how to create wealth in real estate. And today, one of the big ways that we're going to do that is to break down not only what's happening in this renewal crisis, which we've talked about plenty of times before, but the specific strategies that you can take to be able to put yourself in a better financial situation in the near future. But let's get down into the specifics of the problem that we are facing right now and exactly, of course, what our tools are. And then lastly, some unique strategies that you can consider. And of course, some of my opinions on what the future market will look like as we proceed into this current new reality of mortgage worlds. Now, let's get into some of the stats. First of all, I mentioned this before, 60% of all outstanding mortgages come up to the renewal by the end of 2026. And I've already started to see a portion of that renewal waterfall, I guess, if you want to call it that, start to hit. 2025 obviously isn't the biggest year because we only started to see the interest rate market start to dive towards the end of 2020, and 2021 was the big year for the mortgage world. So for all those folks that were in specifically fixed rate mortgages at those 1.8, 1.9, 2% interest rates and variable rate loans as low as 1.15, I even knew that some that were out there at 0.99 are going to see a significant shock or change to the system as they renegotiate or refinance their terms in the near future. Now, about 40% of all mortgages are going to get hit with a potential payment increase, which means that is over over 1/3 of Canadians about to see a change in their budget, specifically as it relates to their monthly payments. That's a big number, guys. Like, we're talking millions of people here. Some stats that are really interesting that I found. First of all, median principal owing on mortgages right now is $245,000. Now, that's nationwide in Canada. You go over to the West Coast here in the Vancouver area, I imagine that number goes up by a couple $100,000, maybe $300,000 or something of that nature. Same thing in Toronto. You head to Saskatchewan, maybe that number is a little bit lower. Regardless, it's a big number. Another interesting place for people that are going to be looking out for some shocks would be the fixed payment variable rate mortgage owners, those who are in VERMs, which is basically every single big bank except for Scotiabank has those products, and that's a variable rate mortgage where the payments remain the same. Some people hit their trigger rate and they ended up making a change or locking in at the time, but I know that there are a vast majority of people in these loans that their payments have remained exactly the same. They've made the same payments, and they are in for a pretty significant shock, with over 12% of those in negative amortization territory. The balance on those has been increasing, not decreasing, at a time when, well, let's be honest, the real estate market has taken a little bit of dive. The big question around that is, will there be people who have enough equity in those properties to be able to refinance and put them out of this debt situation? That it will need to be seen, and we'll see what happens as far as that's concerned. Now, OSFI, as you guys know, the governing body, OSFI, Office of Superintendent of Financial Institutions, is warning their payment shocks they're expecting are as follows: 20% increase in 2025 and greater than 30% in 2026, seeing that increase in the marketplace. With, as I mentioned previously, those variable rate mortgage holders with fixed payments being potentially most exposed. And hands up, I have those mortgage products myself personally. In fact, on 3 of my properties, I had those. And while I have been paying off the interest, I haven't seen much principal pay down in the last 2 to 3 years. I'll tell you that much. Now, one of the big reasons that they are the most exposed, as I mentioned previously, is, again, they've many cases maybe not paid off very much principal, or in some situations, very rarely paid no principal down at all and are in reverse territory. Now, a lot of the banks were calling people for weeks and months, and honestly, the last couple of years to get people to pay interest, but not everybody has the cash to just increase their payments and pay it down. And those people are the ones that are probably at the highest potential risk of seeing some level of shock to their monthly mortgage payments in the near future. Now, on a Royal LePage survey, they said they expected over 57% of people are expecting payment increases. So that's not the amount of people who are going to see that, but that's the amount of people who are expecting payment increases. 81% of those people say it's going to strain their finances. And where this really fits into this conversation is that this type of a mentality will have a real impact on how people opt to, well, spend their money and choose to work going forward as far as their budget and invest into different things that might cost, therefore having an impact to the Canadian economy at a time when everything else has already gone up in price. Feels like people just need a break. It's not just abstract data that I've pulled out. It's literally a major wave of homeowners across BC and all of Canada, Alberta, Ontario, facing serious budget pressures and stress. And for a lot of those people, as I mentioned, it's now. Because if it's happening in the next 12 months, you're thinking about it today. Or if you're not, you should be getting ahead of it right now. So let's get into the tools right now. Let's talk about these tools. What are our different options that we can choose? Now, first of all, I'm going to break down some of the major standard mortgage products, but I want to talk about some of your options they have available to you. So the first one that people could consider renewing into right now is your typical fixed rate loan, fixed rate mortgage. Now, depending if you're coming from a mortgage before or moving into one right now, 5-year fixed rate mortgages right now, you could be had in the low fours and under 4% in some rare circumstances. I'm going to talk about switches and how those work in a minute here, but that's where we're at right now. Now, the market is predicting and watching the bond yields and the swaps, which we've talked about in a previous conversation. So we need to be careful because the current market is projecting interest rates to actually increase over the course of the next 12 months, barring any unforeseen events at this point right now. Now, with that being said, there isn't any expectation right now for fixed rates to continue to go down, which says that any consumer thinking about their renewal in the next 12 months to honestly just look at where rates are at today, talk to your mortgage broker, and use that for your payment analysis. Because the reality is that's probably what you're going to be paying. A current variable rate market right now, prime sitting at 4.95%. After the BOC held rates at 2.75% prime in the last announcement, and that was in June of 2025. Variable rates right now are, for the most part, between a half to 3/4% below prime, which is putting your variable rate mortgage right now at about 4.25 to 4.55%, at the 4.5% right now. Basically, really on track with most fixed rate loans right now. And the reality is, the current market is saying, the Bank of Canada is basically saying, we are in our neutral rate territory. Neutral rate territory is between essentially right now 2.25 to 3.25%. And Bank of Canada's overnight rate is at 2.75. What that means for you is that the BOC basically has this neutral rate that they try to achieve while they're trying to keep inflation in balance. And we're smack dab right in the middle of that neutral rate territory. And so there are many suggesting, well, the BOC is not likely to reduce rates much more, if not maybe 1/4% lower than where we're at today. And so, although the variable rate market in general can offer some interest savings, it might not be as significant as we were previously expecting and hoping for in the past. So, for anybody who's thinking about renewing, when you're considering that variable rate option, I think the reality is you need to be conscious of the fact that, well, if you're doing it because you expect rates to go down, you shouldn't be doing it for that reason. Maybe more for flexibility, maybe more for the fact that you can, obviously, traditionally speaking, break it for 3 months interest. You can lock in if rates do go down, but not because you expect rates to go down right now. Another option for people who are in this current marketplace is to consider what I've called the hybrid model. You could do 50% fixed, 50% variable, and you've got that little bit of stability on one side, and you've got that interest savings potential on the other side right there. And that is a smart play for those borrowers who are really uncertain about this current market, but they want to basically spread their risk in multiple different avenues, if you will. Here's the thing. Going back to what someone can do in this current market right now, whether you're going fixed or short-term 5-year variable, hybrid, or anything of that nature, you need to really understand the mechanics behind those options and think about obviously what your options are as it relates to how you can take advantage of this current market. So, in the next segment, I'm going to get into some different tips that you could take to be able to renegotiate your terms and put you in a better financial spot, and how you can make sure that all these different things that we're talking about here today don't negatively impact your budget. I'll get into that in a minute here. But before I go any further, I want to explain the difference between someone coming up for renewal and a refinance. Now, a renewal is somebody who is renewing their mortgage and keeping everything exactly the same. No changes, same amortization period. Typically speaking, you're just basically signing the dotted line, you're accepting what your bank offers. A refinance is when you're changing something structural about the loan. This could be because you're extending the amortization, taking out equity, moving to another lender who only accepts refinances, maybe changing the product type, going from a standard mortgage to something with a home equity line of credit. In all of these situations, it's going to result ultimately in a refinance, which means that there will be different interest rate options available. Typically, honestly, if you want to get the lowest cost option, it's probably going to take some negotiation with your bank, but your bank should offer you the lowest option to literally just sign the waiver and renew your mortgage. And that's because, well, there's no work for them to do that. Nothing. They basically just need to tick the box, renew your mortgage, and you're on your way. As simple as that. So, I want to talk a little bit about some of my opinions on the market, but of course, what you can actually do here going forward. So, if you are someone who is wondering, okay, which option do I consider in this current market? Let's just rattle these through: variable, fixed, split, short term, or and just general conversations. So, first of all, I have a framework around this between going fixed, going variable, and then where you sit in it. It's 7 questions. If you want to know more about that, you can hit me up on Instagram. Just DM me, prepare, and I'll send you the framework to making this decision. But generally speaking, you're going to go variable if you are disciplined. You can absorb the up or down changes in the marketplace, and you're someone who is expecting further cuts from the BOC, right? You're probably going to go fixed, particularly longer term, if you value cost certainty. You're not worried about breaking the term or the mortgage itself or selling your property or anything of that nature. And you just can't sleep, generally speaking, without fluctuation. Plus, you're looking at the projected outlook right now of fixed rate loans. And you're like, we're looking at this and seeing that right now they're projecting for the fixed rate loan to go up for the next 5 years. And you're saying, well, I want to protect myself and hedge against the next 5 years. Number 4, or 3, I should say, what about the splits, the hybrids, the split 50-50? I mean, those are people who just literally probably can't they can't make a decision one way or the other. Like, I might go fix, I kind of want variable, and you kind of just want to split your the difference. And you got to keep in mind that those products are only available to specific lenders. There's a lot of lenders that don't offer those particular types of loans at all. Fourth option is the short term, and we've heard the 3-year fix has been pretty hot for, honestly, I'd say the last 2 years right now, and it's worked out for some and maybe not for others. We'll see. But the 2 to 3 year is for those who are kind of maybe on the mindset of the variable rate holder, where you think that the market's going to come back down, and or you want flexibility to be able to refinance at the end of that 2 to 3 year term. I'm going to say, like, just breaking this myth: fixed interest rates are not guaranteed to be the best rate option. The variable rate solution can save money, but only if, and this is a big if it's managed correctly and it has the right person. Now, strategically speaking, as I said, I was going to share with you some different options at renewal. But before I get into that, I want to share some general sentiment and some additional notes and stats that I found. On a Rural LePage survey, it said that 1 in 10 renewing homeowners are considering downsizing or renting. That's like 10% of people are considering selling just to downsize. And I'll tell you from personal anecdote, I've helped already at this point right now people refinance, restructure loan, literally to save thousands. Like, one person right now on my plate is worth $3,000 that I'm going to help this family reduce their overall debts. Okay, I promised you I was going to give you some strategies. So let's get into it. Okay, number 1, really simple. You got a mortgage renewal coming up. Please don't wait until 2 months before to figure out your options. 4 to 6 months before your renewal date is when you should start the conversation of your strategy. And I say strategy versus shopping because shopping assumes that you know your strategy. You don't shop until you've figured out your strategy. Now, if you want to do this on your own, feel free. Go ahead. You can do it yourself. You can search up options. You can look at different lenders online. You can try to determine what types of options that you want available to you, do the research, and then go qualify yourself. Or you can work with a mortgage broker who basically helps you strategize that. The mortgage broker itself isn't here to help you get the quote unquote cheapest rate. Yes, that can happen quite frequently because you're offered the best terms that are available in the marketplace first. But realistically, it's to stop you from doing things that are going to cost you money and save your time. If you value your time, then you value working with a mortgage broker. That's part of what a mortgage broker would do, which leads me to number two, which is to shop around different rates and quotes between banks, credit unions, and monoline lenders once we've determined what the strategy is, and specifically once we've determined what your goals are in your loan. The other thing that you want to do at that time is you kind of want to create like a what if worst case scenario buffer, specifically for those who are going variable rates. Like if rates go up a quarter point, can you handle the $100 to $200 payment increase? If rates go up 200 or 75 basis points, can you handle the $300 to $500 payment increase? The fourth thing you want to do is you want to read your renewal offer explicitly from your bank to make sure that it's clear to you what your options are and what your penalties can be. Because some lenders you can get out of early just by paying interest to maturity. Other lenders you can get out of or renegotiate your terms actually early with no penalties. And others won't let you leave until the end of term. There's a lot of different considerations to look at that point, but it most definitely needs to be considered that you have these factors to look for. The fifth one here is negotiation. So if you're doing this on your own, you can leverage one lender against another lender, right? Like your bank is never going to offer you the best term up front. Like they're going to be like 1% higher than the market. And the truth is, if you go back and you're like, hey, I found lender X over here at 0.25% less, they may or may not come down. But if you're about to leave them, on the moment you leave them, they will probably come back crawling and saying, what did you get? I'll come back to you, which is honestly, the people I've worked with, is just maybe a slap in the face and too late. So my feedback is if you really want to stay with your bank and you don't want to refinance, you don't want to restructure, nothing like that, like that's the goal, then just be straight up with them. Like, this is what I've been offered. These are my terms. If you don't do it now, I'm leaving, and then leave if they don't offer you the terms. Remember, these guys are not your friends. They're not, you don't have to be loyal to the bank. There is no reason to be loyal. They're a multi-billion-dollar company there to make your money. Okay. Sixth strategy to consider: prepay and or extend your amortization, or do both to reduce your monthly payments. You can consider prepaying 15% of your annum, or 20% depending on your lender, or 10% if you're with one of the big banks. And you could renegotiate your terms or refinance your terms, which is what a lot of people are doing right now, to extend the amortization. Now you can go from 10 to 15, 15 to 20, 20 to 25, 25 to 30, whatever you'd like. But that can be a lifeline. And I think a lot of people are looking at this as like a failure. It's not a failure. It's you looking at it as a tool and saying, what is the most important thing in my life right now? And if that thing is cash flow, then you refinance to reduce that. But you don't lose sight of your goals, because if your goal is to continue paying down the principal and less interest, you consider looking at increasing your payments slightly or paying lump sums and making sure that you have an account set up so that you can invest that money and not lose on that potential savings that you had. And the last thing is switching. So lender switching can save you 3, 4, 5, 6, 7, 10,000 bucks. And the switch is different than a refinance. This is when you literally take your mortgage and you switch it over to another lender with the exact same amortization or terms in many situations as you had before, with these different considerations, allowing you to be able to get best rates and terms with the new lender. Case in point, you bought your home before, you put 5% down, 10% down, 15% down. If it's insured mortgage or an insurable mortgage, then you qualify to be able to take that loan over and actually get access to lower interest rate options that are available elsewhere than you might be able to get on the free market, because you're essentially taking your insurance over to that new lender, which is going to basically save them money in the process, therefore allow them to be able to give you better rates and terms. Here's the thing: risk is imminent. We want you to avoid the surprises. Ultimately, if you want to unpack your situation and unpack what's going on, we've heard all the horror stories of what's happening right now. We've heard how real people are being impacted. And I've shared with you some of the deep dives in the current marketplace that you have an understanding of, some of the things that you can do. It goes deeper than that when it comes to a specific strategy that we built out for our renewal clients. But these are things that you need to look out for. So in summary, a few key notes that you need to hear from me. Number one, 40% of mortgage renewals in Canada are going to renew at a higher cost. And if you're 4 out of 10 people, basically, if you're one of those people, it's going to cost you money. Quick understanding of exactly how to look at the rate options I just shared with you in 2 words: fixed equals certainty, variable equals potential savings and flexibility, split equals a hybrid balance of the two situations. Okay? In Alberta, in BC, you need to be aware of these considerations because it's going to have a serious cost when it comes to your lifestyle. Here's the reality, guys. You don't have to do this alone. If you're somebody who has a mortgage in place, you can download our framework to renewal decision making, which covers what we talked about plus more. Again, just send me the DM, prepare on Instagram, and I'll break down the decision making. And if you want to set up a no cost clarity call to understand specifically where you stand and what you can do, you can reach me at the Mortgage Pug on Instagram, and I'll be happy to set up a 15-minute call with my team to discuss your options and where you should go from here. Hope you found this episode helpful. If you did, make sure to hit that thumbs up and the subscribe button. We'll see you next time.